Welcome to the lecture on the weighted average cost of capital, or the WACC. Now, the WACC is central to corporate finance. You can't be a finance major, you can't be in finance without knowing WACC. Okay? So it's very important that we cover this in some detail. We're going to give a broad overview of the WACC first. Then we're going to do a very simple example to show how we can calculate the WACC for a company and then use that to evaluate a project. Then we're going to fill out some of the finer details. In part 4, we'll talk about each ingredient for the formula, and we'll see where each ingredient is coming from. And then finally, we'll wrap up. So before we get into the details, I want to place the WACC within this course. So where are we so far, and how does the WACC fit into that? We studied the DCF kind of a long time ago. Before the first midterm, we said, we're going to forecast our cash flows, forecast our free cash flows, and discount them to get the value of the operations. However, there are some assumptions that we've been using. Now, the first is that the cash flows are pretty static. We're still going to stay in that world here when we're studying the WACC. But what this means is that when we forecast the cash flows, those are our best bet. We have some guess as to what's going to happen. That's our best guess. We're assuming that the project's not going to change drastically. Okay. Now, we've relaxed this a little bit thinking about real options. We know with real options, you can change your behavior based on how uncertainty gets realized. We've also thought about sensitivity analysis a bit. We're trying to tweak our assumptions and see if our assumptions make a difference on our NPV. But for now, we're still in this world where the cash flows are pretty static. We're going to stay in that for the rest of this lecture. The other assumption we've had, again, since the beginning of the class is we've had some constant discount rate. We've talked about risk and return to try to get at the intuition there. What is the economics behind the discount rate? But we haven't put that into a corporate finance setting much yet. That's what we're going to do today. How in corporate finance do you get a discount rate? How do we calculate that? That's the weighted average cost of capital. The beauty of the weighted average cost of capital is that it's going to incorporate financing effects. We know when we studied capital structure and Modigliani-Miller that interest tax yields are valuable. So we care about those things. They're just a effect of financing. If you take on debts, you get tax yields. Those are valuable, so we want to incorporate that. The WACC is going to do that for us. The discount rate is going to do that for us. This, so in stars here, this is our first attempt to do that. When we studied Modigliani and Miller, we kind of waved at the tax yields and we said, yeah, these things are important. And then just like any cash flow, you can discount the tax yields. And so we did it in a little bit of an ad hoc way. We want to do it in a more kind of formal, more elegant way now. That's what the WACC is giving us. The key idea is that the discount rate depends on the capital structure because of taxes. We know that debt gets this tax shield. We need to build that into the discount rate somehow. And then next, what we'll do is we'll think about changes in capital structure. So this is the next topic when we study delevering and relevering. We'll think about how the discount rate changes with the capital structure. But for now, we just need to, first step is to build those tax shields into our discount rate so that we can value financing along with the operations of a project. It's going to come down to this picture that we saw at the end of Modigliani and Miller. In this picture, we have debt to equity on the x-axis. As you move to the right here, you're taking on more debt. On the y-axis, we have the cost of capital. And we plot this for debt and WACC and equity as well. What we saw is that when you take on more debt, the discount rate you use for your projects starts to fall. That's the WACC here. If you have no debt, your discount rate is at this intercept here, RA naught, RA 0. It's pretty, relatively high discount rate if you don't have any debt. When you take on more debt, however, this falls because you're getting tax shields. Those tax shields, it's almost like free money, right? You're happy to finance projects because you're getting this tax break for nothing. Just because you raise money, now you're going to get a tax break for it. That means that your hurdle rate's falling. You're willing to take on worse projects because of those tax shields than you would have otherwise. So the thought experiment here, if we look at this figure, suppose we have a project that pays at this cursor. It's like halfway between RD and RA naught, say. Okay, so we've got some project earning this return. If we were financing the project with all equity, okay, so we're at the this point in the x-axis, all equity, no debt, we're getting this return, we would say that's a bad deal. The project's earning more than debt, sure, but it's earning less than our, more than this kind of safe debt, but it's earning less than the assets, less than the equity should be getting. Okay. So it's not earning enough to compensate us for the risk we're taking for our assets. However, suppose we can use debt. Well, if we can use enough debt, we're getting enough of a tax shield that this return starts to look good. Our cost of capital, the WACC here, goes below the return for this project if we can use enough debt. So this project, it was bad to begin with, but if we can get tax shields out of it, then it starts to look good. That's the whole idea here. We need to incorporate those tax shields. They're going to change the decisions that we make. We want to reflect that in our discount rate. And that's what the weighted average cost of capital is going to do. So in short, that's reducing our discount rate. We're going to take worse projects simply because the tax shields are valuable for us. That's big picture where we are in this class. We've seen these things before with capital structure, but now we want to kind of flesh out the details. The intuition for the weighted average cost of capital is, it starts with the first week of class. If I pull up the whiteboard here, we saw this figure in the first day of class. We have corporate finance, right? This is corporate finance in a picture. On the right-hand side, we have all of these investors. Maybe they're pension funds or individuals or private equity, whatever. And any kind of investor you can think of, they've got money. This is just a big pool of money on the right. The financial managers are in the middle. They're raising money from the investors. Okay, so investors are pouring money in here. And then the financial managers, that's us. That's kind of what we're thinking of ourselves as in corporate finance. We have to make decisions about all of these projects. We've got lots of different things we can put our money in. We have to decide which are good projects. How do you make that decision as a financial manager? Well, it depends on your investors. It depends on what your investors require. Zoom in here. You need to know how much your pension fund investors require for the risk that they're taking. That's going to inform your decision about should you mine asteroids or should you experiment with some new special sauce at McDonald's, right? You need to know what your investors require. So let's break down this picture. If we get rid of the pension funds and just think very generically about investors in the slides. Investors are putting money into the firm, and then the firm is investing in projects. Now, the question becomes whether the projects are good, right? Should I put money into the project? The project's going to pay me a return. Should I put money back into the project, or should I return it to my investors? Well, in order to answer that question, we need to know what the investors could be doing with the money. So now we've added this next best investment. We've talked about the discount rates as like the opportunity cost of capital, right? What can you earn for the risk that you're taking, for the systematic risk that you're taking? What kind of return could you get for that? Well, the investors all have a next best investment. So as managers, when we're making a decision about a project, we have to think about what our investors could be doing with the money. How much could they get for the same risk as what our project is going to incur? That gives us kind of the NPV rule. We saw this in the first day of class. Essentially what it boils down to is if the project, RP, if this return is higher than what our investors could get on their next best option, again, conditioning on the risk that they're taking, but if our project can earn a higher return than the next best thing for the investors, then we should take the project, right? That's essentially what NPV boiled down to. It meant that the cash flows here are worth more. cash flows for the project are worth more than the cash flows that the investors could be getting on their next best investment. So in words, if you don't like the pictures, this is all of that in 3 bullet points. These investors are putting money into the capital. They need to get a return based on the risk that they're taking. We call that the required return, the return that they require based on their risk. So from our perspective, from the CFO's perspective, from corporate finance's perspective, we need to consider that. And that's our cost of capital. That's how much it's costing our investors. The investors are our boss. And so when we make decisions, it's got to be kind of relative to that next best thing. That's the price of capital, the opportunity cost of capital, we've been calling it. We can draw this with multiple investors, just like we can do it with one investor. So let's think about the two basic types of investments in a company. We have debt, we get a bank loan, and then we have equity investors. So this left-hand side is the same. We still got the financial manager here in the middle. We've got projects that we can invest in. These projects are earning RP, some return on those projects. We need to consider both of our investors now. We need to think about what could the bank be earning on their next best investment. And then likewise, we have to think about what the equity investors could be earning on their next best investment. Again, conditioning on risk. So what could the bank earn? Well, it's going to be different than what the equity holders can earn because the equity investors are taking more risk, right? So RE is going to be higher than RD. The point is, what could they get given the risk that they are taking? We need to combine those two things to get the firm's cost of capital. Since we're getting money from both the bank and the equity investors, we need to summarize all of that and get one number. We need to have one number to compare RP to and decide, is RP worth it? That's the WACC. Okay, what the WACC is going to do is it says, well, we got to pay, let's start with the equity holders. We have to pay the equity holders RE. That's their next best investment. And how much of the company is owned by the equity holders? Well, it's E over V. V is the total value of the firm. E is how much is owned by the equity holders. So this is how much of our return, RP, we're generating return RP, we have to give this much to the equity holders. And then likewise, we have to give this much to the bank. The bank holders require RD. Bank holders own D over V of that. And then we do something a little bit different with the bank. We multiply the cost of debt by 1 minus T. This 1 minus T is picking up the tax shields. The bank needs to earn RD. However, when we pay the bank that return, it doesn't really cost us that much. It doesn't cost us RD. Why? Because we're getting a tax shield when we pay the bank. Any return that we give the bank gives us a tax break. And so it's less expensive to us. It doesn't really cost us the full RD. It costs us RD times 1 minus T. Every $1 in returns that you give the bank, let's say your tax rate is 30%, you give $1 in returns to the bank, that saves you 30 cents in taxes. So that $1 only costs you 70 cents because you get 30 cents back in taxes. Okay, so this is the cost of the firm's capital. We got to pay the bank this, we got to pay the equity holders this. We're going to compare both of these things to the return on the project. Okay? And if the project is earning more than these two things together, then it's a good project and we should take it. If not, then it's a bad project. In an equation, so we have this picture. This picture is just illustrating this one equation. We have a weighted average cost of capital for the firm. It has two pieces. This is the cost of paying back the equity holders, right? This is that bottom arrow here. And then we separately have the cost of paying back the debt holders. That's this top arrow here. RE, this is how much the equity holders require on their next best investment. EV is the ratio of the equity to the total value of the company, right? It's the ratio of the equity market value to the enterprise value. Likewise, RD is what the debt holders require on their investment for the risk that they're taking. And then DV is the ratio of the value of the debt to the enterprise value of the company. T is obviously the tax rate. And then we know that the total value of the company is the sum of equity and debt. So this V here, this denominator, that's equity plus debt together. You put it all together, that's the value of the company. We talked about the tax shields already. We said that when you pay the bank $1 in interest, it gives you a $1 in tax break. So this WACC is picking up the after-tax cost of capital. So if the equity holders need 10% given the risk, we got to pay them the full 10%. There's no getting around that. But if the debt holders require a 5% return, then it only costs the firm 1 minus T times 5% because you're getting those tax shields. When we have the WACC, what do we do with it? Okay, so this is all kind of nice. We've talked about this discount rate. We've talked about paying back our equity holders and our investors. And what's the punchline once we get this point? All we need to do is discount free cash flows by the WACC. And that's going to give us the total value of the project or the firm. If we're forecasting all the free cash flows for the firm, we discount it by the firm's WACC. That gives us the total value of the firm, the enterprise value of the firm. It's going to include both the operations as well as the financing. Okay, it includes the financing here, 1 minus T, right? We said that this is picking up those tax shields. So when we use the WACC, we're capturing both the value of the operations and the value of the financing in kind of one fell swoop. So it's a very elegant way to value projects. When we started at the very beginning of the semester, before the first midterm, we were just focusing on the operations. And then when we studied Modigliani-Miller, we started to think about these tax shields, but we didn't have a clean way to value them. Well, the WACC is giving us that clean way. With the WACC, all we need to do is discount the free cash flows by the WACC, and we're getting the value of all those tax shields plus the value of the actual operations themselves. So again, the equation, if we want to think about it in words, it's the average of the after-tax expected rate of return on all of the outstanding securities. So the standard securities are debt and equity, but we can think about multiple, other types of securities. It's any way that the firm is raising money that should show up in their cost. Right, so we could have like 3 or 4 or 5 different types of financing here. Same concepts apply. We still have to pay them back based on their next best investment. One thing to note is that the firm has one WACC for the entire firm. Okay. This is something to keep in the back of our heads. We're going to revisit this later. But this is kind of something I want you to be thinking about. The value of the company's equity, that's for the entire company, the entire value equity of the entire company's equity. Likewise, this is the value of the entire company's debt, D. Right, this is the return on all of the equity. This is the return on all the debt. Right, so the firm just has one WACC. This is going to create kind of some limitations. If we want to use the WACC, we better be sure that the project we're evaluating looks like the rest of the firm. If it doesn't, then it's the wrong discount rate. what do we mean by this? That it looks like the rest of the firm. In the slides, we call this a carbon copy. When you sign a contract, you sign on the top piece of paper, and there's usually 2 or 3 kind of carbon pieces of paper beneath that, so that your signature gets implanted directly on the below carbon copy. So it's an exact copy of the contract that you're signing. The same way, the projects that we're evaluating with the WACC have to be carbon copies of the entire firm. This has to hold on both sides of the balance sheet. So recall, what is the value of the firm? Well, it's all the assets. That's equal to the debt plus the equity. When we use the WACC, our operations have to look like the rest of the firm, and our financing have to also look like the rest of the firm. Let me enumerate those. So when we say carbon copy, we can boil it down to these 2 points. The operations of the project have to look like the operations of the company. Otherwise, the operations of the project are going to have a different risk than the operations of the company. Similarly, the financing for the project has to look like the financing of the rest of the company. If this is how the entire company is financed with this much debt and equity, well, suppose your project is financed with like 100% debt, whereas the firm is financed with 50% debt, 50% equity. That creates a problem because your company has more, your project has more debts than the company. So you're getting more tax shields than what's typical in the company. So your discount rate would be different. Okay. So if we want to use the WACC punchline, we need a carbon copy of the firm on both the asset side as well as on the financing side. Okay. And this last bullet point is about the assets. If the project has a different risk than the existing business, then the WACC is not going to be appropriate. And likewise, if the financing is different, then the tax shields are going to be different, and the WACC should be different. So I think it's somewhat intuitive. You just kind of look at this equation and you think, well, if I'm going to use this discount rate for my project, these numbers should hold for my project. And in order for that to be true, you need to have your project needs to look like the rest of the firm. Okay. Now that we've got the kind of the broad intuition, we have the formula down. We've talked about the limitations a little bit. I want to do a very simple example just to fix ideas and to make sure that we know what to do with the WACC once we have it, and what does it give us. We're going to consider this corporation, Sangria Corporation. First, we're going to compute their WACC, and then we're going to use that to value the company. We have some information on their financing. We see that their cost of equity is 14.6%. They have a pre-tax cost of debt of 8%, and we have a tax rate of 35%. So just looking at the WACC formula, we have RE, that's required return on equity. We have the RD, that's the required return on debt. And then we have the tax rate. So we put those 2 things together to get the after-tax cost of debt. So just as a note, in case it wasn't clear yet, RD times 1 minus T is the after-tax cost of debt. RD is what the debt holders require, but that doesn't cost us RD, it costs us RD times 1 minus T. Okay, so for Sangria, we have the following information. We have the rates and we have the tax rate. We need to figure out debt and equity. We need to know how much of the company, V is the total value of the company, how much of that is financed with equity and how much is financed with debt. In the next slide, what we're going to get is book and market value balance sheets. We're going to use those to compute the WACC. Okay, so now pop quiz. Are we going to use book values or are we going to use market values to calculate the WACC? We're going to use market values, right? This is finance. We almost always use market values unless there's some weird accounting thing that we care about, like a tax shield or something. We care about market values. When we drew this picture before, right, these are market values. This is how much economically I have to give to the bank, how much economically I have to give to the equity holders. That's a very different thing than what the accounting balance looks like. So we just cross off the book values. If we can help it, we're not going to use book values. We're going to focus on market values. So here we see that the debt is worth 50, the equity is worth 75, and so the total company value is 125. I'm going to go back to the WACC formula. I'm going to replace the value with debt plus equity. That's 50 plus 75. So if you want to rewrite the WACC formula, you can put equity plus debt in the denominator instead of value, because it's the same thing, right? The total value of the company is the sum of its debt and equity. So the equity has a market value of 75, debt has a market value of 50, and the total value of the company is the sum, so 125. All right, so that's everything we need, right? We have all the ingredients down. We calculate it, we put it into our calculator, and we get about 10.84% for this company's weighted average cost of capital. And we'll kind of round to 11% in the notes. What do we do with that? This means that all of our investors, we can pay all of our investors as long as our projects earn 10.84%. Say that in words. If our project earns 10.84, then we have enough money to pay both the equity holders and the debt holders in proportion to what they need. So that's a good project. So let's think about valuing the entire company now using this WACC. We're going to discount free cash flows by the WACC. And what is that going to give us? It's going to give us the total value of the company. The operations plus the interest tax shields. We saw this notation in Modigliani-Miller size. We saw that the total value of the company is the value of the company without any debt. It's like the value of the operations plus the value of the tax shields. When we use the WACC to discount the free cash flows, we're getting both of those things together. In the entire sum, VU plus VITS. So let's think about Sangria's free cash flows. So yeah, punchline here before we get into the free cash flows. With this WACC of 11%, when we have projects that are carbon copies of the firm, right, this WACC is for the entire company. So when we have projects that kind of look like what the rest of the company is doing on both the asset side and the financing side, then we can use the WACC to discount those things. When we use the WACC, we are accounting for the tax shields. That's this sentence here. We're going to get both the value of the operations and the tax shields all in one step. So now let's turn to Sangria's free cash flows. Let's make sure we can pin those down. Then we'll combine those free cash flows with the WACC to get the total value of the company. So Sangria has the opportunity to invest in a new crushing machine. We want to see, is this a good deal or not? Should we invest in this project? The required initial capital expenditure is $12.5 million. And we're going to assume, just for simplicity, that the machine's going to run forever. Okay, so today I have to pay $12.5 for this CapEx. We also assume that the project looks like the rest of the company on the financing side. Right? The project is financed using the same debt to equity ratio as the entire company. So obviously a crushing machine, that sounds like something Sangria Corporation should do, right? That the asset of a crushing machine kind of sounds like what a Sangria Corporation is doing. So the asset side looks like the rest of the company, and we're told explicitly here that the financing looks like the rest of the company as well. So all of this means that we can use the WACC, right? Let me spell that out. That's all. It's just kind of a lot of throat clearing to say the assumptions of the WACC are true. This WACC for the entire company is appropriate for this crushing machine because it looks like the rest of the company. We see what's going on with the crushing machine going forward. It's going to generate an EBIT of $2.5 million per year, kind of in perpetuity. Okay, so it's a very simple cash flow, right? You have a CapEx of 12.5 today, and then you get an EBIT of $2.5 million per year forever. Should the company do this? Should they take this project? We're going to ignore depreciation and net working capital. So all we have is this initial CapEx and then this EBIT, this perpetuity. So what do the cash flows look like at time 0? Well, remember what the free cash flows are. We have EBIT times 1 minus T plus depreciation minus CapEx and minus increases in net working capital. In this case, what happens at time 0? Well, we just have the CapEx. We just have that minus $12.5 million today. We know, if you remember back from the first midterm, you don't generate EBITs at time 0, right? It takes time to accrue revenues and expenses, likewise no depreciation. And here we're told to explicitly ignore net working capital. So all we have is this CapEx, negative 12.5 today. And then what happens in the future? From time 1 to infinity, we have this perpetuity, this EBIT of 2.5. Now that's not the free cash flow. We have to multiply that by 1 minus our tax rate, which was given above at 35%. We're going to ignore depreciation. We're going to ignore CapEx and net working capital going forward. So all we have is 1.625 in free cash flows in perpetuity. So how do we put all this together? What do we do with it? Well, we're just going to discount the free cash flows by the WACC, and that's going to give us the value of this project. So we have the WACC up here, about 11%. We have the free cash flows. We're just going to discount them. The NPV for this project is going to be that free cash flow at time 0, and then we have a perpetuity. So we're going to discount that by the WACC. This is just our perpetuity formula, cash flow divided by the discount rate to get the present value of all those future cash flows. We have a minus 12.5 today. Then we have 1.625 in perpetuity, discount that by about 11%. Put all that together, what's the investment worth? It's going to be worth about 2.5. 491 million. So what's embedded in this 2.49? This includes both the tax shields as well as the operations. We didn't have to separately think about the tax shields. We didn't have to separately value them. They're embedded in the discount rate. They're embedded in the WACC because we were using the after-tax cost of debt. What's the after-tax cost of debt? That means that we're already kind of pushing our discount rate down because of the tax shields. When we do that, that means that our valuation is going to go up. We push the discount rate down, that's going to increase the valuation by the amount of the tax shields. Okay, so that's what's included in this 2.491. It's going to be both operations and financing. Now that we've got the kind of simplest example down, where we walked through the discount rates for this company, we saw the market value for their debt and equity, we put all that together to get a WACC, then we discounted very simple free cash flows by the WACC to get a value of the project. We see that that includes both the operations and the tax shields. Okay, so that's kind of the basics. Next, I want to talk about some of the finer details when we're using the WACC. The first detail to talk about is this target capital structure. When we use the WACC, we need these ratios, the value of equity over the total value of the company and debt over the total value of the company. Now, those things need to stay pretty constant. So suppose what happens if those things change? So suppose the value of equity over the total value of the company changes. What else changes? Well, obviously the value of debts changes, right? If it used to be 50% debt, 50% equity, and now we have 25% equity, that means that it's now 75% debt, right? So you change the balance of equity. Now the ratio for debt also changes. That's kind of obvious. More subtle, however, is RE. We know that RE changes because of M&M number 2. As you take on more debt, the equity gets riskier. Okay, so the point is, these ratios have to be pretty constant. The capital structure has to be pretty constant. It has to be stable at a kind of target level, or else the entire formula is going to be changing. And if the discount rate is changing over time, then we can't use it for much. So this is an assumption that we're at some target capital structure that's going to give us a stable WACC that we can use to discount free cash flows. In reality, we know that the capital structure fluctuates a little bit. The idea is that there's this kind of constant rebalancing toward the target. So if the equity goes up a little bit today relative to the debts, well, then in the future, maybe we'll take on more debts to bring these two things in line, right? We need to kind of be approaching this target. Now, what is the target? How do you figure that out for a given company, knowing that equity and debts are going to naturally fluctuate based on how the stock market's doing or how interest rates are doing, et cetera? How do you figure out the target? How do you figure out what this EV really is for a company? You could just look at the capital structure in the past. Right? If it's pretty stable over time, then you figure out if on average it's been half debt, half equity. Well, that's probably the target. That's probably what they're shooting for. Or you could look at what management is saying. The CFO is going to kind of tell investors what the plan is for the company's capital structure. And so you can use that to infer about the company's WACC. Not all companies are going to have this target. So some companies that are changing a lot, they're not going to have a target capital structure, and so you really can't use the WACC, or at least it's very hard to use WACC if the capital structure is changing. So if it's true, if you've got like a young growth firm, if you've got an entrepreneurial company, maybe they start off with all equity, and then once they get big and stable, then they take on more debts. If you have something like that where the capital structure is just going to naturally evolve over time, then you're not going to want to use the WACC. Right? Too much stuff is changing when you change the capital structure here. We're going to introduce a new method next week called the APV, the adjusted present value, which is much more suited for situations where capital structure changes. The next detail is about cash. Now, cash is always a special account. When we studied free cash flows, we know that cash was treated differently. If it was excess cash, we left it out of the free cash flow calculations. Something similar is going to be happening here. In particular, when we use debt in the WACC, here, right, that's a very important piece, D over V, what are we actually going to use? We're going to be using what's called net debt. Once again, we're going to be taking out the excess cash. One way to think about this is if you have this excess cash that's not used in the operations, then it's really a financing item. You're choosing to hold this on your balance sheet. You could choose to pay off your debt, right? You have so much cash, you have so much debt. You could choose to pay off some of your debt using that cash. The fact that you don't means it's financing, so it's not part of your operations. The other way to think about this is this cash is earning some return. You have this cash, you put it in some bonds, and you're earning a return on that. You're paying on the debt that you have, but you're earning a return on the excess cash that you own. So the net effect is what we care about, right? The net debt is how much debt you really have. You're taking on some debts, but you're also lending some money. That's what you're doing with your excess cash. You're just kind of lending it out in bonds. So how much debt do you really have? Well, it's the difference between how much debt you took versus how much you're loaning out with your excess cash. Okay, so that's net debt. One more way to think about this is, again, if you think about the enterprise value that we studied way back when, we have the enterprise value plus excess cash is equal to debt plus equity. Now you see in the WACC, we're using debt and equity. If we just use the raw level of debt and not net debt, if we just use the total value of debt, what are we going to get when we do this? We're going to be getting the average return on both the cash and the enterprise value. Do you see that? If you take the weighted average return on the debt and the equity, that's going to be the weighted average return on the assets and the cash. Okay. But we don't care about the cash. We're not going to be discounting our cash. We just want to have a discount rate for our operations. That's what the WACC is doing, right? We need a WACC to discount the free cash flows. We don't care about the cash. So what we want is we want to separate, the enterprise value by itself. So what we have left is debt minus excess cash plus the equity. So you take the weighted average of these two things, net debt and equity, that's going to give you the appropriate discount rate for your operations. If you don't take out the excess cash, then the discount rate from the total debt and the total equity is going to be an average of the return on your operations and your cash, which isn't very useful. Okay, so this is all just to say we need to take out excess cash. It's just an annoyance, but we're used to it with free cash flows. Next, I want to think a little bit more about this RD, the cost of debt. We said that that's what the bondholders require. Now, we know if you think about our lecture on bonds, we know that the bondholders are pricing in risk of default. So their return is partially a function of default. So we need to think about that a little bit. If we have this this company, what is the cost to us? Well, we said it's the after-tax cost of debt. We have what the bondholders require, RD. We multiply that by 1 minus T to get the kind of true after-tax cost to the company. Okay, so this company has a tax bracket of 34. The investment banker estimates that the yield to maturity of a bond would be 8%. Calculate the after-tax cost of debt. Well, we get 5.28. Okay. So we're comfortable with this. Now, the question, the finer details here is, when is yield to maturity a good measure of RD? Right? RD is what the bondholders need. The yield to maturity is the return when the company does not default. So it's going to be a good approximation as long as the company is pretty stable. As long as the company doesn't have a high probability of default, then the yield to maturity is going to be a good estimate of your cost of debt. If you've got a kind of junk bond with a high probability of default, then that's not going to be true. But as long as the company's pretty stable, then it's going to be fine. And that's what we'll use. That's what we'll use for the discount rate on debt, is the yield to maturity. This feeds back into this target capital structure idea. The idea is these things have to be pretty stable. If the company has a high probability of default, then it's not stable, right? So if it's not stable, then we're just not going to use it. The WACC is not going to be a good tool to begin with. So likewise, if the company has a high probability of default, the WACC is not going to be a good tool. We need some other way to do it. Okay. Moving on, so we talked about yield to maturity as a approximation of the return on debt. We can think about equity as well. We'll need to get a return on equity. It's going to depend on beta, but also on leverage, obviously. We know from Modigliani-Miller too that you take on more debt, the cost of equity goes up. So we need to account for both of these things. We can also have multiple different types of equity. So the standard is to have common equity, RE. But suppose you have something called preferred equity. Well, we can just modify the WACC a little bit for new sources of financing. We have debt, we have equity, and then say we have preferred equity. It's a third source of financing. It's worth P, and it has a discount rate RP, the required return on RP. So we can do that too. So that would be another kind of detail. You can just tack on extra sources of financing to your WACC. Right? The WACC is the average of all the financing. All the investors require return. When you put all that together into one number, but it's pretty flexible. You just take a weighted average of all these new sources of financing, and you're fine. Okay. So let's put all that together with an example. We're given a lot of information about firm A. We just have to put it all together into the WACC formula. Okay. So they have $300 million in debt. We see the cost of debt is 7.33%. The common equity is worth $450 million. That's what the market capitalization means. It means it's worth $450 million. They have $25 million in excess cash, $50 million worth of preferred stock. The cost of their common equity is 12.6. The cost of their preferred stock is 9.5, and they have a 30% tax rate. So what is the WACC? We look over here. Here's the WACC formula. Just a weighted average of each of these components. We have to take the information on the slide, put it into the formula, and that's it. Then we'll be done. So we can start, let's say we move left to right here. E is the common equity. So how much does firm A have worth of common equity? Well, that's $450 million. Right, that's their share price. We know that that's worth $450. How about V? How much is the total firm worth? How much are all of the sources of financing worth? Well, what sources of financing do we have? We have equity, common equity, we have debt, and then we have preferred. We know that the equity we just said was worth $450. We know that the preferred is worth 50. So I'll do that first. And now here's a little bit of a tricky part. The debt is worth $300 million. Okay, firm A has $300 million in debt. Now, we don't want to forget about the excess cash, however. Remember that when we're doing this, we have to get rid of the excess cash because we want to focus on the free cash flows, right? We want to discount the free cash flows. We want to get the enterprise value. The cash is its own thing. We want to separate it from the enterprise value. So how do we do that? We said we take it out from the debt. So we're going to use net debt. Anytime we calculate anytime you see a D, anytime you see a debt value, it really means net debt. So instead of having 300 million in debt, you really have 300 minus the 25 in excess cash, right? $25 million in excess cash. So we have 275 in debt. That means we have 575 total. That's the total value of all the investments in the firm. It's 575. So back to the WACC formula, we have 450 in equity. That's out of the entire 575. What is the cost of equity? What is the discount rate on the equity? That's given here, here, a cost of equity of 12.6%. Okay, so we found it in the paragraph. We just put it in there. How about debt? We're just moving left to right. We said that the debt is 300 minus 25. That's the total value of the debt minus the excess cash. The total value of the company is still 575. We multiply this by the cost of debt, which is given at 7.3%. And we multiply that by 1 minus the tax rate, which is given at 3% or 30%. Last piece, preferred. What is the preferred worth? So it's kind of a lot of numbers. You have to sort through it. It says that the preferred is worth 50 million and the cost of preferred is 9.5. So the required return on the preferred stock is 9.5. Okay, so we have 50 in preferred divided by 575 total, and that grows at 9.5%. Okay, so a lot of numbers. You just plug all of this into your calculator, you should get 9.75 total. It's just a matter of being very systematic with the formula. We have the formula, we just have to go piece by piece. If we don't have it on hand, we have to calculate it like V, right? We didn't have that number given to us, but we could calculate it given everything we had, or debt. We had to calculate net debt, but we had everything. We just had to kind of take it piece by piece and work through it. Okay. Next, I want to talk more about estimating the cost of capital. So when we have the WACC formula, we've got a discount rate on equity, we got a discount rate on debt, and we have a discount rate on preferred here. We'll talk about where those are coming from. In the previous example, those were just given. I just told you, just gave you a bunch of numbers, just spat them out at you, and you had to put them into the formula. But economically, how could we figure out these things? Okay. As we know, these costs of capital, these discount rates, these are what investors require given the risk that they're taking. Okay, so it's going to be different for equity and debts and preferred. Where are they coming from? If the security has predictable cash flows, so like a bond, right? With a bond, you write a contract that says, I'm going to get these cash flows. Or with preferred stock, we'll talk in a second about what is preferred stock, but it has very predictable cash flows. You can back out the rate of return using market prices. If you know what the cash flow is, and you know what the price of the asset is, then you can infer the discount rate that puts those two things together. So we'll do that for debt and for preferred. For equity, on the other hand, we need a little bit more of a model, right? We can't just go from cash flows to prices to get a rate. We need to have some kind of a theoretical model for the risk of equity. Well, we have CAPM, so we're just going to keep using that to get the expected return on equity. Turning more towards the debt, it's important to note that debt, there's lots of different types of debt out there. If you're going to be using the WACC, you generally can't use firms, you can't calculate a WACC for firms that have kind of very risky debt, junk debt. We mentioned above that the yield to maturity is only going to be a good measure when the probability of default is low. We said that here just because you need a stable company. And if the company is not stable, if there's a risk of default, then the yield to maturity is not going to be very good. And you're just outside the scope of the weighted average cost of capital. You're not in a world where you can use it if the company could default. So it's worth breaking down a little bit and talking about the difference between investment grade bonds. These are bonds issued by companies that are very safe. They've got high credit ratings or very, very low default risk, versus what's called like junk debt. As the name suggests, there's kind of a high probability of default. Sometimes these are called high yield debts because, again, there's a high risk of bankruptcy. So the yield to maturity goes up because of that. So the WACC method is just not well suited for speculative grade stuff, junk or high yield bonds. We'll need some other tool. We'll use something called the APV later to try to deal with these situations. But the WACC is kind of plain vanilla. You need to be very stable. You need to have kind of boring companies where you're not going to approach these issues. You may be interested, this is a little bit outside the scope of this class, but when credit, like S&P, Standard & Poor's, they rate debts, they assign a grade, they assign a rating to debt based on how risky it is. So the safest debt would be something like the US Treasury, and that would be rated AAA. And these just never default, very, very low probability of default. As you go down these ratings, you're getting into riskier and riskier stuff. So the cumulative probability of default in 10 years for investment grade bonds, these are safe bonds, it's going to be less than 1% for anything A and up. Could go up to 7% for triple Bs, but generally very, very low probability of default over a 10-year horizon. And when we cross this red line, we officially move into what's called junk, high yield bonds. And then we see that the probability of default starts to be quite meaningful, right? 20% in 10 years, all the way up to 87%. So now there's, pretty good shots that the bond is going to default. So for companies below this red line, the default risk is too high. WACC is not going to be good. You need something else. There's just not enough stability to use WACC appropriately. But if we have investment grade debt, so if we're up here, we've got pretty safe bonds, we'll use the yield to maturity. We kind of hinted at this before. The yield to maturity is a good measure of the discount rate on debt as long as the risk is low and the company is stable. So that's going to be our benchmark. We're going to get that from the bond yield to maturity. Some other kind of minor notes, you want to use longer term bonds. Company's going to be around a while. You want to use long-term debt, not necessarily short-term debt. And the other issue with bonds is that a bond is a contract. So you can have lots of different contractual terms built into it. Those things mess with the prices and the returns a bit. And so it's better to get as simple of a bond as possible. A straight bond would be the way to describe it without options or warrants or anything like that. Now, if they don't have bonds, then you have to get a little bit more creative. You can look at other companies that do have bonds that have similar risk, right? That would be a natural way to go about it. Or you can look at the St. Louis Federal Reserve. They release yields on kind of groupings of debt. So they look at very high, very, very safe debts and see what the yield is there. They look at slightly riskier debt and see what the yields are there. You can use that to try to infer what the yield would be on your debt, even if your debt is not trading. And then finally, if it doesn't have a public debt rating, then you kind of have to get even more creative and back it out. But for our purposes, we're always going to have a yield to maturity when we're doing the WACC because these are going to be stable companies. Okay. Now, how about preferred? We haven't defined preferred, so I want to do that real quick here. When you buy a share of preferred, you're essentially buying a perpetuity. The dividend, you have a fixed dividend, or it's not growing or anything, it's just a fixed payment, and it's paid at regular intervals, every year or something, kind of forever, right? If not forever, then as long as we can foresee. for all intents and purposes, preferred looks like a perpetuity. So how do you value a perpetuity? Well, we can calculate it using our week 1 perpetuity formula. So what's going to be the share price of preferred, say? Well, you're going to have a dividend on the preferred, and then you need to have a discount rate on the preferred. This is our perpetuity formula, right? Cash flow divided by discount rate. That gives you the value, the present value. So how can we back out RP using this information? Well, you can just solve for RP. You look in the stock market and you see the price of the preferred stock, and you look in the contract, or you see what the preferred stock has been paying, and you see the dividend, right? You know the dividends per share here on the preferred. You see what it's been paying, you see what the price is, so you can just do one step of algebra to solve for the required return on the preferred. That's what I have in the slide here. The required return on preferred is just the dividend that you're getting discounted by the market value of the preferred. This is called the dividend yield. If you buy 1 share of preferred, you're paying the price in the denominator, and you're getting the dividend in the numerator. So this ratio is the yield. What is your dividend yield from buying 1 share of preferred? So that's preferred. It's just a perpetuity, so we can solve for the discount right there. We said that if the cash flows are predictable, like a perpetuity, you can use the price and the cash flows to infer the rate. That's what we're doing here. Same thing we were doing with bonds. When you use the yield to maturity, you know what the contractual payments are on the bond. You know what the price of a bond is, so you back out the yield to maturity. So that's all we've done with preferred and debt. Now with common equity, we're generally going to use the CAPM. These slides are all review from the risk and return slides. We saw how we can estimate the beta for a company's equity. We did it for ExxonMobil, we did it for Southwest, and a few other companies. You're just plotting the returns for your stock against the return on the market and looking at the slope. So I'm not going to review this here. We already talked about which values to use for the risk-free rate. We talked about how to get the beta on the equity and the market risk premium here. It's always good to review how do you calculate the expected return on a company's stock. If the beta is 1.83, you have a risk-free rate of 1.75, and you have a market risk premium of 6. You just walk through the CAPM to get 12.9. Okay, so just to summarize all of that here. We're generally going to use CAPM to find the discount rate on equity. I'll give you the beta or something, and then you can back it out. All right. So we've talked about discount rate on equity, discount rate on debt, and preferred. What about the market values, right? What about these ratios? For equity, we'll generally know what the share price is for each stock. We'll know how many shares there are outstanding. So you just multiply those two things together to get E. Right? We've done this a couple times already. That's nothing too novel. We do the same thing with debt. What's the market value of bonds? Well, you know what the price of a given bond is, and you know how many bonds there are. So you multiply these two things together to get the total value of all the bonds. Now, if the debt is not traded, so for example, if it's a bank loan, then we can't calculate a market value precisely. Generally, what we'll do is we'll use market value is equal to book value. So as long as the company's pretty stable, that's going to be okay. It's not ideal, obviously. You want to have a market value, something that's trading. But if we can't, then worst case, we'll just use the book value, and that's going to be a close approximation. Last thing to remember with debt is we have to subtract off excess cash. Now, that's just kind of an annoying point to keep in mind. Don't forget about short-term debt. That's going to be in a different place than long-term debt. And generally, we're only going to have one cost of debt. So if you've got a bank loan and bonds, for example, you're only going to have one cost. The risk of that debt should be the same, really. As long as these bonds aren't kind of complicated or weird, the risk on the bank debt should be about the same as the risk of the bonds. So we're only going to use, in that case, the yield to maturity on the bonds. We'll use that discount rate for all of the debt. So we'll do one example here. This company's got a lot going on. We'll put it all together to find their WACC. Big Oil has the following sources of financing. They've got a bank loan, they've got bonds, they have some common equity, and then we're told something about retained earnings. We're asked to find their WACC. We're given some information on their equity. We see it's got a beta of 1, kind of like Exxon, which we calculated in class, before the second midterm. A risk-free rate of 6 and a market risk premium of 7. And the tax rate for the company is 35%. We're going to assume that the firm is at its target capital structure, that the bank debt has the same risk characteristics as the bonds, and that the firm has no excess cash. Okay, so a lot of information, just throw it at you. We just take each piece of the WACC formula, just break it down. We can go left to right and find the WACC for Big Oil. Okay, so let's just work. We'll just start at the top and we'll work our way down. So the bank loan, that's worth $200 million. So that's obviously part of debt. So debt is equal to 200. Now that's not the end of the day, however, because we also know that there are some bonds. So we've got a bank loan and then we've got other bonds that all shows up in the debt. So that's just one piece. The firm has been paying interest of 7%. We're going to come back to that. That interest rate on a bank loan, that is not the required return necessarily for debt. Okay, so we're not necessarily going to use that for RD. I'm going to come back to what we should use for RD in a minute, but this thing is a little bit of a red herring. The interest rate on the debt of 7%, that's a bit of a red herring. Okay. Let's move to the second point here. We've got a bunch of bonds. What are we going to do to find the value of debt? Well, we've got the bank debt, but then we also have to value all the bonds. We've got 200,000 of them, and we have a lot of information on each bond. They've got a face value of 1,000, coupon rate of 8%, paid annually, and a term of 12 years. The bonds are currently trading with a yield to maturity of 9%. And so if you want to get the value of all these things, we'll just value one bond and then multiply it by 200,000. Here you can't forget how to value a bond. The coupon rate is 8% paid annually. That means that how much are you getting paid in coupons every year? It's 8% of the face value, 8% of 1,000. That's your coupon. The yield to maturity is 9%, so that's going to be our discount rate. Let's clean this up one second. So here's our annual coupon in the numerator. Here's our yield to maturity in the denominator. This is part of our annuity formula, right? We have an annuity of coupons. And this annuity is going on for 12 years. This is the remaining maturity of 10. So this is a cash flow. This is a stream of cash flows. It's an annuity of coupons, $80 each, going for 12 years. We also have to value the principal amount. Right? We said that the principal is not part of those coupons, so we have to discount that separately. Just to make sure we're all on the same page. What did I just do? I skipped a step, but it's just yield to maturity. It's coupon divided by yield to maturity times 1 minus 1 divided by 1 plus the yield to maturity raised to the n plus f divided by 1 plus the yield to maturity raised to the n. This is our bond pricing formula. When we have annual coupons, it's relatively straightforward. We don't have to cut the coupons in half or cut the yield to maturity in half if we're getting paid annually. All right, so this is all review. You put all this into your calculator. Going to cheat here and see what the answer was. So each bond is worth about $928. So how much are all the bonds worth? Well, we've got 200,000 of them, and they're each worth 928. So that means that all of the bonds are worth about 186 million. Okay. So that's going to be part of our debt. We have 200 in bank debt, 186 in bonds. Okay. And then the last thing we need is to subtract off excess cash. We said that we only care about net debt. We look down, where's excess cash, blah, blah, blah. Okay, no excess cash. So that makes it a little bit easy. We don't need to deal with that. We just have 386 total in debt. All right, so it's a fair amount of work, but that gives us the first piece of the WACC formula. What about the discount rate on debt? I said we would come back to this. We're going to use the yield to maturity of 9%. Okay, that's the yield to maturity. That's the market rate. If you were to buy one of these bonds, you pay 928 for that, and you get a 9% return. We're not going to use this interest rate of 7%. Okay, so let's make a note of that. You know, why not the 7% rate on the bank loan? We always want to use market prices when we can. The yield to maturity is a market price. The interest rate on the bank loan, maybe it was a market price when the loan was originated. So when Big Oil got the bank loan, the bank said, okay, I'll accept a 7% discount rate or a 7% interest rate on this loan. But who knows when that was? That could have been, you know, a year ago, 2 years ago, 10 years ago, whatever. The point is the yield to maturity is something that you can look in the bond market today and see that. You see that investors require 9% return today to buy this bond. That 7% interest rate on the bank loan, it's not as nice in that sense. It's a little bit stale. So we think that this 9% yield to maturity, if bondholders require that, then the bank should require that too, because the bonds and the bank debt have the same risk. That was explicit here. The bank debt has the same risk as the bond. So we're always going to kind of tilt things toward the market rates, which is the yield to maturity. All right. So moving along, we have the value of debt. We have the discount rate on debt. We have the tax rate that's given at 35%. Next, we have to deal with equity. Done with this top one, we're done with the second one. We've got 10 million shares of common equity outstanding with a par value of $10 each, currently trading at $120. So what is our equity worth? Well, we have 10 million shares. How much is each share worth? This par value thing, that's a bit of a red herring. That I don't even know what that means in accounting terms. That has some accounting meaning. It's not a market value. Right? We care about market values. If you go back to the sangria example, right? We got rid of the book values and we only use market values. So what's the market value? Well, you look and you see that each share is trading at $120. So you have 120 of them, or 10 million of them, and they're trading at $120 each. That means that you've got $1.2 billion worth in equity. I think if we have the total value of debt at 386 and we have the value of equity at 1.2 billion, that means we can find the total value. That's debt plus equity. So that's going to be 386 plus 1.2 billion, or 1,200 million. Keep everything in millions for simplicity. We have 1586 million in total value. So you see what we're doing? We're just taking it piece by piece. Last thing we need is the discount rate on the equity, and then we'll be done. We know the beta on the equity is 1, the risk-free rate is 6, and the market risk premium of 7. So we're golden. We just need to walk through the CAPM like we've done so many times before. We get a 13% required return on the equity. Last thing is just plugging it all into the formula. We've got 1,200 in equity over a total of 1,586. The required return on the equity is 13. The debt is worth 386 out of a total of 1,586. The required return on the debt is 9. Oops. And then the tax rate is 35. So you just run that through your calculator and you'll get 11.26. We took a lot of data. We just took it one piece at a time until we had everything, and then just throw it into the formula. Wrap up now in just a couple minutes. Big picture, we calculated this WACC. We know that it's very nice because it's going to incorporate financing for the first time in an elegant way. When we have the WACC, you forecast the free cash flows. Now remember, the free cash flows ignore financing. The free cash flows are just from the operations. The financing effects is showing up purely from the WACC. Free cash flows are just from the operations. So you forecast those free cash flows, then you discount those free cash flows by the WACC, and then it simply, is NPV greater than 0, take the project. If not, don't take the project. That's it. The financing effects are in the discount rate. We're pushing the discount rate down because we multiply by 1 minus t. Right? We're pushing the discount rate down here. When you push the discount rate down, the value goes up. The value is going to go up by exactly the amount of the tax shields. So when you use the WACC, you're capturing the tax shields because the discount rate is lower than it would otherwise be. So the WACC is taking care of the tax shields for us. This is the Sangria example. Just to remind you, we were using the free cash flows. We were not taking the tax shields out here, right? When we calculated taxes, we were assuming we were going to get taxed the entire 35% on the EBIT. That's not true though, because if we had debt, our taxes are going to be lower. You have debt, you're getting a tax shield. So actually your taxes are going to be lower than 88 cents because you're shielding it using the interest. When we calculate the cash flows though, we ignore that. We don't account for the tax shields in the cash flows. The entire effect of the tax shields shows up in the discount rate. Okay, we don't want to do it twice. We don't want to have the tax shields show up in both the cash flows and the discount rates, and we're double counting things. We keep the cash flows from the operations. We discount them by the WACC. That gives us the total value of the project, including the financing. Okay, so this is just an important note here. We don't double count the tax shields. These are the caveats with the weighted average cost of capital. We have one WACC for the entire company. So if you use it, that WACC has to look like the rest of the company. It has to be a typical project for the firm. If the project's risk is different than what the firm is doing, then the WACC is going to be inappropriate. It's not going to properly reward the investors for the risk that they're taking, and we'll need to do something else. Likewise, if the project is going to change the company a lot, then the company's old WACC is not going to be appropriate, right? So that comes natural if you're the WACC is going to be at the firm level. And so if the project changes the firm, then the WACC is going to change. If the capital structure changes, then we saw that a bunch of stuff changes. In particular, the equity beta is going to change. The required return on the equity is going to change. And so you're going to have to recompute everything. Okay. finally, we have this note on conglomerates. Same idea. The WACC is for one WACC for the entire firm. So if you've got multiple divisions, you have to be very careful to match the risk that you're using, the discount rate that you're using, to the risk of the division, not necessarily the risk of the entire company. So we'll leave off here. What we'll talk about next time is how to relax some of these limitations. How can we discount projects in a conglomerate? For example, we have to make certain adjustments to the discount rate to reflect the different risks in each division and perhaps the different financing sources in each division as well.